Man, if I'm Tim Cook, I'm flipping a switch to shut off Ricky Gervais's iPhone. Just want to give you an idea of, so what we talked about so far is somebody like an individual making a decision about whether to incorporate his or her business. And the issues are sort of based on tax rates and whether the individual has an opportunity to retain money inside the corporation. As I said before, if the individual needs to take out all the money to buy groceries, integration might leave the individual in the same place the individual was at without incorporating. Now that, of course, takes an accountant or somebody to do tax under scenario 1 versus scenario 2. And perhaps the individual would still incorporate to enjoy benefits like limited liability and those types of things. But essentially the tax reason to operate a business via a corporation is about rates. So in the extreme, 50% versus 13% or in Manitoba 9%. What is the psychology for a large corporation? What's the psychology for a company as big as Apple as regards taxes? So Apple's fiscal year end is in September. I don't know why, except that September is probably the end of its busy season, probably shipping toward Christmas deliveries kind of in September to its various retail customers. And this is their official audited consolidated statement of operations, which is another word for income statement. And all I want to show you here is that taxes gets its own line, and Apple apparently pays or will pay somewhere between 10 and 13 billion US dollars per year according to this. But my point is that taxes is just a line on a financial statement to a company of this size, or frankly any other public company. And they say, look, we manage things like our manufacturing cost, which is included here. Apple themselves are not really manufacturers. They buy manufactured product from other people. We manage those costs. We manage our R&D costs. We manage our administrative costs. Income taxes, that's just another cost that we manage. There sort of isn't a personal thing in it, as there would be for a lawyer who's thinking about whether to incorporate. Is just another line in the financial statements. And the corporations feel they need to manage it, they feel that they have the right to manage it, and so says the Duke of Westminster and Judge Learned Hand. As you may know right now, in the United States, corporate taxes are the most interesting single tax issue for two reasons. The United States drastically reduced corporate tax rates, and drastically increased the deductions that a corporation can claim for buying equipment and stuff like that. And this might be the biggest one. Drastically reduced the tax that a corporation like Apple pays when Apple brings cash back into the United States from its operations in Europe, Asia, and other places. In the United States, before the current regime, when you brought back money from foreign operations, you had to pay tax of something like 35%. In Canada, that tax is 0. In the States, 35%. And the president stood up and said, well, when we bring all this money back, think of the jobs that will be created and that type of thing. And now I'm speaking about a political issue and an economic issue that's got nothing really to do with tax law. But the question is sort of what are the consequences and what actually happened. And some would argue that yes, maybe some jobs were indeed created because The American jobless rate right now is at an historic low, like 3.2% or something. And then also there were some other things going on, like corporations returned money to shareholders, not by dividends, but by share buybacks. There are some pros and cons to that. But in any case, all of these things were driven by the fact that there were some significant changes in corporate tax law in the United States, easily the biggest changes in a generation. Point of this, taxes to a large company, just another manageable cost line, and that's the psychology that they employ. I find that takes the emotion out of tax planning. That corporations sort of have it right, large corporations. They say, hey, this isn't a political issue for us or anything. We're just managing our costs as if it were another cost. Tax cost is just something that we look at, and we look for ways to reduce that cost, and all you folks are folks that help us do that. I had both public and private corporation clients, and most of my public ones did business, actually most of my private ones did business in other countries. And we'll be talking about doing business in other countries. It's actually a very important and interesting part of tax planning generally. Let us go back to page 428. I want to take, please, a deeper dive into this integration thing. And here we're talking about small corporation tax on the bottom. Now I'm going to tell you that this is only allowable, that is, a corporation can only enjoy this small rate of tax, 13% or 9%, on the first $500,000 per year of active business income. And the corporation has to share that $500,000 limit among companies with which it is associated. And we'll talk more next week about what associated means. Let's say that there's only one company in this group and it made $700,000 last year. So the first 500 would be taxed like this, and the next 200, total 700, would be taxed like the top of the page, which is a higher corporate tax rate, 27% versus 13%. Fair enough. And then blah, 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 if that income gets paid out, there's tax to pay by the shareholder. And it actually turns out that there's a bit of double taxation if a company earns more than $500,000 a year. There's actually more tax to pay than if the individual earned that money personally and paid 50% tax on it. So in that case, that's actually a case where incorporating produced a bad tax result, or a result that's worse than if the proprietor were not incorporated. Proprietor said, yes?
Like, I understand this double taxation, but is it still necessarily worse? Like, if I invest that money that I would have saved anyway in the corporation, keep it for 40 years, could I not make more than that 3% double taxation rate, or is it kind of just like, once you have anything, it's not good?
Yeah, but you would have, well, that's right. Honestly, if you left 73 cent dollars inside the company,
yeah,
you're right. That's exactly right. But ultimately, when you take it out, as they say, so yes, thank you. I love the idea that the deferral would still happen. It's not as good as deferral, but hey, it's still a deferral. I like it. Honestly, what most people do, most corporations do, they simply, in our $700,000 example, pay a bonus out to the shareholder of $200,000. Thus, eliminating this, making sure that the bonus is taxed at only 50%, not 53%, if it were left in the company and paid out as a dividend. Is that a good thing to do? We'll talk more about that when we talk about taking money out of a company, but generally speaking, yeah. If the person who received the money is sort of the president and CEO, and her effort is responsible for the success of the company, she can take out $5 million a year as a bonus and expect to be able to deduct it, for the company to be able to deduct it. Question is, company's paying a dividend, and the decision has been taken, yes, we're going to pay this dividend, this is what we're going to do, but what pot does it come out of? Was it part of this pot here, $200,000, or part of this $500,000 pot? And it's important because the tax on the dividend is different. If the tax on the dividend is actually lower if it comes out of this pot as compared to come out of this pot. And the reason for that is because at the end of the day, the Income Tax Act wants the thing to be as close as possible to 50% combined. And since the company paid very little tax here, the tax on the dividend is much higher than here, where the company paid twice as much tax in the first place. We call these, and I'm reaching for my pen, and I would encourage you to do this on page 428. These are eligible dividends, and these are non-eligible dividends. That word eligible, non-eligible, I actually don't like. Eligible for what? I'm not really sure. Eligible, I guess, for a lower rate of personal tax to the shareholder, because higher rate tax is paid by the corporation. In this case, non-eligible. I'm not eligible for the, make sure I get this right, not eligible for the low tax on dividend to me. I therefore pay a higher rate of tax on dividend, and that's because my corporation paid low tax in the first place. So that's what that's like. Yes?
So just to confirm my understanding, if I get $5,000, I would rather be eligible than non-eligible?
You would much rather be eligible than non-eligible, because you'll pay a whack less tax on it. All you have to do is prove that it came out of this pot, not that pot. How does one do that? If you go please to page 424. We have an account called the general rate income pool. So this top thing here, that's the general rate thing, regime, let's call it. This is the low tax regime. General rate, high tax, small business rate, low tax. So an accountant keeps track every year of the amount of income earned by the company. And the lawyer, who, believe me, doesn't want to do that tracking, wants the accountant to do it. But the lawyer has to say to the accountant, hey, my client wants to pay a $100,000 dividend. I need you, accountant, to tell the client and me which pool it comes out of. The top pool or the bottom pool. And the client, the shareholder who's going to receive the dividend, very much wants it to come out of the general rate income pool. That is the top pool, out of income that the corporation paid high tax on, because then the individual will pay low tax. And in the dividend resolution that you will prepare, you need to indicate whether it's an eligible dividend, that is one that was paid from the general rate income pool. And to know, to be able to say such in the dividend resolution, it's on you to make sure that the accountant gets asked, hey, which pool is this? You'll never have to calculate the pool yourself. I don't want you to, but you just have to know that there is such a thing as a pool, such that when somebody's taking money out of the corporation as a dividend, they very much want to maximize the amount of the dividend that comes out of that general rate pool. That is the top of page 428, not the bottom, because they will pay a whack lower personal tax than dividend. How much lower? Might need my calculator for this one. Tax paid by individual shareholder. $256 on a dividend of $730. That is 35%. How much is it on the bottom page?
40.
Bottom page. 40.
43. It says 43, so that would be my guess. Tax at 43%.
Thank you. That's a pretty good guess. And apparently I can use a calculator awesomely because, but my glasses aren't as good. 35%. 35 versus 43. I really, honestly, I want my dividend to come out of the top thing, not the bottom thing. Thank you.
I have a question. Is that dividend pool progressive the same way that the income is taxable as well? Or is it, right, because it's the small, the CCPC is the first 500,000 and then the higher tax rate above that. For this, is the eligible, is the pool you can deduct from do you deduct from the non-eligible or the eligible just indiscriminately? Or do you have to pull from one first?
Believe it or not, the answer is actually simpler than your question. I'm going to tell you how the GRIP pool gets calculated, and I want you to forget it. It's simply 72% of $1,000. And there's no rule that says you have to go take it out of the pool or not. You just want to really badly. And it's up to your discretion, actually. If you want to, you could take a non-eligible dividend, but you'd pay a lot more tax on it.
Okay, so the pool is just calculated at 72 and then that's just it?
That's it. And please now forget about the 72. Yeah, it's one of those things that people said, well, okay, how are you going to do this? Like, how are you going to tell? Like, how many pages is this going to add to the Income Tax Act? And how many lines of code have to be written? And then somebody said, well, let's just say it's 72%, which I think is awesome. So that's how it gets calculated. And the point is that most people would so much rather pay tax at 35% than 43%, that they'll do their own due diligence to make sure that the GRIP gets calculated, and the lawyer will be smart enough to say, you should really call this an eligible dividend in your dividend resolution. Any questions on that? So, in summary, and we're talking about business income here, which honestly is the most common type of income that's earned by a corporation. I mean, Frank in Frank's corporation, that's business income. Professional income is regarded as business income. So this is how it gets calculated. In years when Frank's income is like $800,000, 300 would be here, and 500 would be there. And then Frank would have a GRIP balance that he would have to calculate and decide whether the dividend he takes is eligible or not. Or he might have decided to pay a bonus, which would bring his income down to $500,000 to avoid this double taxation. Or he might say, you know what, I love the fact that I'm only taxed at 27%. I'm going to let that money ride inside the company and let it grow with 73-cent dollars rather than 50-cent dollars in my own hands. Please go back to the Income Tax Act. Let's have a deeper dive into some of the rates. So I am on, let's see. Page 18 again, so XBIII. In the 2019 column, which, by the way, in my own, I'm going to circle to make reference to it easier, and you might consider the same, especially when you're writing an exam. So general rate income. It says here, general federal rate, general. So that's top of page 428 income, big company income. There is a calculation as to how we get there. 38 minus 10 is 28. And a so-called general rate reduction ending up at 15%. I just need you to know about 15% and where to find it. So there might be a question like, Robson Corporation, public company, earned $10 million of business income in 2019. How much was its federal tax? Answer, 15% general federal rate. 15% of whatever number I said that I've already forgotten.
I have a quick question.
Yes.
Why is there a section for, when it says the less general rate reduction or MFP deduction, is that always the case?
Short answer, yes. There's an historical reason that, by the way, don't take notes on this. There used to be something called I guess still is the manufacturing and processing deduction, which you can claim if you're a manufacturer, but you can also claim something called the general rate reduction. And there's really no distinction because they're the same rate. And honest to God, I don't know why we even have both of these still here. Manufacturing and processing thing comes into play in the calculation of some provincial taxes. Saskatchewan and Ontario come to mind. Otherwise,
So as far as federal rates, the provincial abatement is always applied, and the general rate reduction or the MMP deduction is always applied. So it will always get you to 15 for the federal rate. Okay.
yes. But the Act still has each of these numbers defined in the statute or the regulations, hence why the Act publishers feel obliged to show a table that's got 4 numbers that add or subtract up to something. But honest to goodness, it's 15%, which in my copy, I'm going to circle. And I don't need you to know that it starts at 38% and winds its way down. I just need you to know 15 and 9.
Sorry, so in that example of Robson Corporation, $10 million, they
Yeah.
have this tax rate, federal tax rate 15%, but that would be on the 9.5 million after the 500 million percent, 9%, or am I?
Thank you for your question. Robson Corp is a public company,
Okay.
and therefore doesn't qualify for this whole other 9% thing. And we'll talk more about that next week. Please turn the Income Tax Act to section 125. So as I just mentioned, the Crazy Income Tax Act doesn't just say someplace, the tax rate on big companies, top of page 428, shall be 15%. And the tax rate on small companies will be 9%. It says, somewhere it says 30 something, and then somewhere else it says you gotta subtract 10% off that. And then somewhere else it says there's this general rate reduction. And more importantly, somewhere it says there's something called the small business deduction. And the small business deduction is how we get down to 9%. And I'm just gonna keep my finger on that page, but I'm gonna go back to page 18. And the small business deduction is 19% to the good. So the small business deduction, which is the subject of section 125, is 19%. It's a reduction of tax rate, 19%. So this whole thing started with 38 minus 10 minus 19, and if there is a God, the sum of that is 9. I hope that's right. 38 minus 10 is 28 minus 19 is 9. So this is the subject of section 125. There may be deducted from the tax otherwise payable, which is always a great way for a provision to start. Under this part refers to part 1. You'll notice that there are several parts. Here's part 12.4. Most of our course will talk about part 1, which is essentially where income gets measured and tax and deductions are made available and tax is calculated, mostly in part 1. There may be deducted from the tax otherwise payable under this part for a taxation year that was throughout the taxation year a Canadian-controlled private corporation. A Canadian-controlled private corporation. Those are the only types of corporations which are entitled to claim this 19% to get down to 9%. Canadian-controlled private corporation. Does anybody remember CCPCs from your first tax course? Can you talk me through what it means? That is, what does a corporation have to do to qualify? Yes?
Residents of Canada, I think 50% controlled by people within Canada and not public.
That's actually pretty good. Let's start with the easy one first, which is not public. Public means that the shares of the corporation are listed on public stock exchange. And by the way, I know these books are heavy and you're going to be unhappy to drag them to every class, but we're going to go through the Act about this much in every class, so I promise you that you will have something to do with it when you get here. Public corporation, so says section 89. I'll give you the page number, it's 593. After this week, I won't get the page number. Corporation that's resident in Canada. If at that time a class of shares of the corporation is listed on a designated stock exchange in Canada, which for the most part is the Toronto Stock Exchange. So if we're public, that is if our shares are listed, that bounces us out of the definition of Canadian-controlled private corporation. To be a Canadian-controlled corporation, first has to be a Canadian corporation. which is essentially one that is resident in Canada, which generally speaking means one that is incorporated under laws of Canada or province. Canadian controlled is a bit of a misnomer. As you may recall from your first course, it doesn't require the corporation actually to be controlled by Canadians. It just cannot be controlled by non-residents. I hate double negatives, but the Income Tax Act is full of them. In this case, it is a corporation that is controlled that is not controlled by non-residents. And for the most part here, de jure control is the type of control of which we speak. That is control that is sufficient to elect a majority of directors. Back to section 125. Here's where we get 19%. Honest to goodness, they update this every year. It was this until then, and this, and now it's 19. It'll be perhaps something else by 2022. We only get to claim the $500,000 limit. We only get to claim the small business deduction to the extent of $500,000 of business income earned by our corporation or a corporation that's associated with others. We'll go through that definition next time. This $500,000 has been there since Frank and I were at university. Maybe it was $250 then, but seriously, it's at least 30 years old, that $500,000 limit. I do not know why we are stuck at that limit. It has not been inflation adjusted. Many other things in the Income Tax Act are inflation adjustment. For some reason, this is not. I think it's a travesty. There, I said it. It's been said. These definitions that I'm going through are things that I need you to read after class and know for the purpose of exams and such. Everything I say in class will be examinable unless I say otherwise. And I'm pretty good actually at saying, don't even write this down. But with regard to, for example, the definition of CCPC, you do need to know this. So private corporation, and private is actually defined someplace else as not public.
89.
In 89, yeah. So private means not public. So again, another double negative deal. So a private corporation, other than one that's controlled directly or indirectly by any manner, whatever, by one or more non-resident persons. Indirectly, here's the company I'm trying to test. It's owned directly by this holding company, and the holding company is owned by this non-resident corporation. Even if this is a Canadian corporation, the fact that this company is owned indirectly by this one means that this is not a CCPC, because it's controlled indirectly by non-residents. I'm assuming this is 100% and this is 100%. The sweet spot, therefore, in corporate tax land is business income earned by a corporation that's eligible for the small business deduction, the benefit thereof is to be able to defer a whole whack of tax otherwise payable if the income were earned by an individual. The way of tracking whether income is earned by top of the page 428 or bottom of the page is what accountants do. Lawyers just need to know to make sure that the accountants are doing what they should, so that the lawyer can do what she or he should, which is to correctly document the dividend resolution as coming from eligible, i.e. out of the GRIP, or non-eligible. And an individual who's trying to determine whether to incorporate is all over page 428. A large corporation, for example, Apple, is more just trying to manage a cost of doing business. Apple doesn't really choose whether it wants to be incorporated or not based on tax rules. And the fact of incorporating, which is one of the three types of tax planning, different entity, different type of income, changing the timing of income. First one, type of entity, is just tax planning. It is not controversial. There will never be an issue whereby CRA says, oh, you shouldn't have incorporated to earn this business income. That'll probably do it for today, unless you have any questions. I will provide lecture notes and readings from today by Thursday at noon. Also, assuming no technical difficulties, which I have occasionally with regard to video. Like once in a while, I'll forget my card, which is all of which I'm saying is if you decide to miss a class, please know that there may not be video of that particular class. I will also say, though, that there are no marks for participation or attendance in this course. And the lecture notes that I give you are like my personal lecture notes. So like you will see everything that I use and that I have, plus the video. You need not apologize to me if you miss a class. I hold nothing against you for that. And finally, as discussed in the course outline, we'll have progressive throughout the term evaluation, which means please stay on top of the readings and practice questions. Thank you and have a good night.
Maybe highlight the third bullet of your syllabus under course technology, because it's atypical, because in the law school, you are an exception. The third bullet. Students may record lectures